Imagine a single family so adept at moving money and calibrating risk that cabinets waited for their couriers. Generals altered timetables to match their remittances, and ministries reshaped policy to keep their favor, not because they wore crowns or commanded regiments, but because they understood the new weapon of the 19th century, credit. For more than a century, the Rothschilds were not merely bankers. They were the synapses of an emerging European financial nervous system, carrying signals faster than monarchies could mobilize men, translating political will into funded capacity, and teaching states a lesson that still governs our world. The seat of power can be a counting house as surely as a throne. Their rise reads like a tale of intrigue, because they mastered the tools of an era when news rode on horseback and fortunes turned on an hour. Private intelligence, cross-border networks, standardized debt, and a family strategy that turned 5 brothers into a continent-spanning machine. Strip away the folklore and the conspiratorial smoke, and what remains is more consequential. They engineered a way of doing finance that outlived their dominance and became the architecture of modern statecraft. The point of origin is not a palace, but a cramped shop in Frankfurt's Judengasse, where Meyer Amschel Rothschild, born in 1744, dealt in coins and curios for princely clients and learned a hard arithmetic about power. Coins were a business, relationships were an institution. The turning point came when he became financial agent to the Landgrave, later Elector, of Hesse-Kassel, one of Europe's wealthiest rulers, whose soldier rents and investments threw off rivers of cash that needed discretion, velocity, and judgment. Meyer grasped 2 truths that most rivals missed. First, in an age of coin shortages, mints of varying quality, and ceaseless wars, the ability to assemble, transport, and transform payments across jurisdictions was as valuable as the money itself. Second, a partnership that spanned capitals could arbitrage not just prices but politics. So he did something audacious. He turned a family into an institution. He placed his sons where it mattered: Amschel in Frankfurt, Salomon in Vienna, Nathan in London, Karl in Naples, and James in Paris, each with autonomy to trade, lend, and invest, each bound to the others by blood, training, and a private law of trust, all sharing intelligence and capital with a speed no kingdom could match. That decision, to make geography the family's balance sheet, was the innovation on which everything else rested. Europe at the turn of the 19th century was a patchwork under stress. The old Holy Roman Empire tottered, Prussia and Austria jostled, Britain guarded the seas, and France under Napoleon tried to reorder the continent by force. Wars devoured coin, armies needed pay and transport, and traditional treasuries were clogged by distance, corruption, and bureaucracy. The Rothschilds built what states could not: a private courier and bills of exchange network that could move specie or its equivalent from one capital to another in days rather than weeks, settle accounts invisibly, and compress risk by balancing flows, an advance here offset by a receipt there, so that fewer wagons of gold needed to rattle across dangerous roads. They were dealers in speed and certainty, and in a world where a delayed remittance could stall an army or topple a ministry, speed and certainty are forms of power. Nathan Mayer Rothschild in London made that power visible. Arriving in the 1790s to trade textiles and coin, he studied the city's markets the way a tactician studies terrain, learning how the Bank of England's operations, the Exchequer's needs, and the East India Company's flows created predictable tensions and windows. During the Napoleonic Wars, Britain's global fight required payments to allies on the continent and to forces scattered from the Iberian Peninsula to the Mediterranean. Gold and silver were heavy, ships were vulnerable, and Napoleon's system tried to choke commerce. Nathan, with his brothers, cracked that constraint. They arranged for bullion procurement where it was available, leveraged their agents in Holland and Germany, and pushed funds quickly to Wellington's armies. They also learned to trade on information, legitimately in the sense that their couriers were faster and more reliable than government messengers. The famous Waterloo legend that Nathan, first to know of Napoleon's defeat, shorted British consols to stampede the market, then bought heavily at the bottom, is folklore embroidered on a kernel of truth. The truth is simpler and more profound. Information advantage coupled with balance sheet and distribution. is an instrument of state-scale finance. After Waterloo, the British government deepened its reliance on Rothschild syndicates to refinance war debts and manage subsequent borrowing. The family did not conquer Britain. Britain, by necessity, enlisted the family. By the 1820s, the Rothschilds had become something no one had quite seen before, a sovereign debt house whose brand could make or break an issue. They systematized what had been episodic. Instead of courtly begging and ad hoc loans, they underwrote government bonds, standardized promises with published terms, coupon payments, maturities that could be traded across borders, and sold them to a widening investor public. They priced risk in a recognizable way and policed reputation. A state that defaulted would pay more next time if it could borrow at all. They helped steady Austria after the Napoleonic wreckage, lent to Prussia and to France during the July monarchy, brokered deals for the Papal States, and guided new borrowers, Spain, Portugal, and emerging Latin American republics, into the discipline and the traps of global credit. The practice we now take for granted, governments issuing bonds into an international market that judges them daily, was knit into habit by their syndicates. In this sense, their signature innovation was not the glittering image of vaults piled high with coins. It was the less photogenic systemization of trust. The family's genius was to see that money, as the public imagined it, metallic wealth in chests, was less decisive than the plumbing that connected promises to payments, confidence to cash. They used their network to flatten shocks. If Paris seized with political unrest, London could temporarily shoulder flows. If Vienna had specie but needed paper credit, Frankfurt could intermediate. They were early practitioners of what modern central bankers would call lender of last resort behavior, only they did it for profit and stability at once, and the lender was not a state, but a family partnership. They also diversified beyond sovereigns into the arteries of the industrial age. Where railways needed capital and political agreements to chew through mountains, Rothschild syndicates financed tracks in France and Austria and negotiated with ministries to secure the concessions. Where mines needed deep pockets and patience, they took equity in Spanish copper and mercury. The canal that shortened empire, the Suez, felt more attainable because a network that had always monetized distance could now monetize a passage that shrank it. They trafficked not only in coins and paper, but in the enabling infrastructure of growth. Power always attracts story, and the stories that formed around the Rothschilds tell you as much about 19th century anxiety as about the family. As the bond market replaced the divine right of kings with a more impersonal fiscal discipline, people looked for a face behind the numbers and found 5 of them. Rumors metastasized. Did the Rothschilds install and topple ministers at will? Did they fan revolutions to buy low and sell high? Did they hold the hidden levers of empire? Such claims commit the oldest analytical error in political economy, personifying a system, but the error has its logic. Ordinary citizens sensed correctly that power had migrated. Where the 17th century had made statesmen who squeezed taxes and clipped coins, the 19th made statesmen who courted syndicates and clipped coupons. The Rothschilds were not puppet masters, but they were architects and enforcers of a new order in which credibility had a price and access to credit was rationed to those who met it. The family's reach did not go uncontested or unbounded. Baring brothers in London, Hottinger and other houses in Paris, the Oppenheims and Warburgs in German lands, and later the great German universal banks competed. The very logic of standardization created conditions for broader participation. Once sovereign debt had recognized forms, more institutions could underwrite and distribute it. Central banks matured alongside this private architecture. Bank of England reforms in the mid-19th century, the Banque de France's rising heft, the Austrian National Bank's stabilization work, gradually shifting the role of lender of last resort from private houses to public institutions. And the United States' late to formal central banking would eventually create the Federal Reserve in 1913, institutionalizing in statute functions that the Rothschild network had performed informally, discounting, liquidity provision, and crisis management. Success at systemic scale is self-limiting for a family firm. A model robust enough to prove indispensable is attractive enough to be imitated and nationalized. The 19th century high tide crested and then receded under the pressures of the 20th. 2 world wars, a global depression, revolutions and genocidal anti-Semitism tore up the elite networks of old Europe. The Rothschilds' houses in Vienna and Frankfurt were expropriated by the Nazis. Art, archives, residences and businesses were seized. Family members fled or were persecuted. Paris operations survived but were scarred. Even where property was restored after 1945, the old ecology was gone. Dollar supremacy, the emergence of Bretton Woods institutions, the rise of mass securities markets in New York, and the ascent of regulated, technocratic central banking moved the center of financial gravity away from the private pan-European houses that had once arbitraged courts and cabinets. The scale of post-war finance itself became a boundary condition. No family could command the balance sheet that the combined public-private American system could muster. If that were the end, great house rises, shapes an era, is eroded by events, this would be a handsome but narrow story. It is not the end, because their most durable legacy is not an estate inventory. It is a set of institutional habits that govern us still. Contemporary sovereign finance follows the Rothschild template. States issue standardized debt to diffuse investors. Private syndicates underwrite and distribute. Markets price credibility daily. International flows offset national shocks. And information moves along privileged circuits faster than public notice can catch it. Every debt crisis since, Latin America in the 1980s, Asia in the late 1990s, Greece in the 2010s, has played out on a stage they helped build. Political authority on one side, balance sheets and spreads on the other, with the outcome determined by whether a borrower can keep the confidence of those who intermediate between promise and payment. Modern giants, BlackRock, JP Morgan, Goldman Sachs, are not heirs by blood but by function, occupying nodes in a network that took shape when a Frankfurt shopkeeper sent his sons out to colonize risk. That is why conspiracy theories, even when they name the wrong culprits and exaggerate hidden hands, reveal a useful discomfort. People sense that money is neither neutral nor merely an accounting convenience, that those who stand at the tap, where credit is created, priced and rationed, live by different rules than those who receive it on the far end in wages or small business loans. The Rothschilds did not design that asymmetry to spite the world. They operationalized it to make finance work at continental scale. But asymmetry there is. Those nearest to the source of liquidity can spend at yesterday's prices, while those furthest away face tomorrow's. Those with network position can convert information into allocation and allocation into influence. It is not a secret cabal. It is a system with a gradient, and the family was among the first to climb it. The modern Rothschilds remain. Rothschild & Co. advises companies and governments. Branches in Paris and London manage wealth. Family foundations fund conservation and culture. And the name still carries weight because it stands for competence earned over centuries. Yet their relative scale in today's markets is modest compared to institutional behemoths whose assets dwarf 19th century imagination. That is precisely the point. When people today speak the family name as shorthand for hidden control, they are borrowing a 19th century symbol to interpret a 21st century machine. The paradox is that the myth grows as the personal dominance fades, because the system their methods accelerated does not need a family at its center to rule by its logic. A world in which central banks set rates, sovereigns issue bonds into global pools, and asset managers allocate trillions according to models, is a world operating on Rothschild principles even when no Rothschild is in the room. It is worth returning to the hinge moments to see how deliberately those principles were fashioned. When the family underwrote Austrian loans in the 1820s, they demanded fiscal reforms and transparency because they knew markets were not churches. They do not accept articles of faith. They require audited statements. When they refused to float bonds for states they judged profligate, they weaponized reputation as a constraint more credible than royal vows. When they built courier lines and standardized bills of exchange, they proved that information, trust and time are convertible. and that those who shave time most efficiently profit most reliably. When they poured capital into railways, they were not speculating on a fancy. They were aligning finance with reductions in economic friction, magnifying the very thing their own business needed: cheaper, faster, safer movement. That alignment of financial technique with real economy infrastructure is one reason their influence felt constructive, even when it pressed hard. They funded and enforced interdependence. There is also a harder edge to acknowledge. The discipline of capital is impersonal, and impersonal discipline can flatten legitimate political desires. 19th century governments chafed under the constraints that came with Rothschild money: reduce deficits, restrain patronage, raise taxes, reform administration. Those demands were not whims, they were risk management. But they placed elected and unelected rulers alike in a bind still familiar. Do we satisfy investors or constituents? And in that bind, citizens saw a displacement of sovereignty. The comparison to the present is obvious. When a rating agency downgrades a country or a spread, widens until a bailout is necessary, the language is different and the actors are diffuse, but the sensation, politics bounded by markets, is the same. It is not that one family controls outcomes, it is that the architecture channels them. So the lesson is not to search for a dynasty behind every curtain, it is to read the stage directions built long ago. Modern finance is a choreography of promises, prices, and pipes. Its rules favor those who issue credit over those who consume it. They reward speed, discretion, and diversification. They punish opacity and delay, and they make information power by definition, not by conspiracy. The Rothschilds did not invent those rules ex nihilo, but they codified them at scale and made them the default. If you want to understand why a government can fall on a failed bond auction, why a rumor can add billions to a market cap by mid-morning, why a central bank sentence can change mortgage rates in a day, you are tracing lines laid down when 5 brothers built a firm that moved faster than armies. History's rhyme is precise here. In an earlier era, kings who clipped coins or debased metal discovered that markets impose a different reckoning than courtiers do. In the Rothschild era, monarchs and ministers learned that credibility must be earned and can be priced. In ours, elected governments discover that the electorate and the bond market both vote, the first on a calendar, the second every minute. The family that taught Europe to live inside that reality is now a symbol, a name on brass plates and museum wings. The machine they helped assemble is the water in which states now swim. To mistake the symbol for the water is to miss the only leverage available to citizens. Understanding how flows, not faces, set the terms. Money has always decided who rises and who falls. If you don't learn its history, you'll be the one paying the price. Subscribe to Financial History and uncover the lessons that rulers, bankers, and empires hoped you'd forget.